Well, good morning, everyone. This is Larry Welch again, coming to you from the Texas Asphalt Pavement Association, and we happen to be down at Texas A&M, the Transportation Institute, and we have Dr. Dave Newcomb today as our guest, and he's going to be talking about accepted practice for lifecycle cost analysis for pavements. Dave, thank you for joining me today. I appreciate it.
Yeah, Larry, it's always a pleasure.
We want to remind everybody that we do record these webinars, and they will be on our webinar library on our website, texasasphalt.org. Go look those up, and you can visit any one of them that we've been saving for the past couple of years. Next month, we're going to postpone the webinar for 1 week, so it'll be on the 24th of September, and we'll be doing mixed types and their applications. This is a great one to revisit. Talks about the different types of asphalt that's available to us and the application we can use in, which gives us another choice. It'll be a great webinar. Our annual meeting is right during the time that we normally have our webinar. So just set your calendars. It'll be September 24th, 10 a.m. It'll actually be the fourth Thursday of the month. So we're going to go ahead and get into the presentation. Also, just real quickly, I'd like to remind you again about our annual meeting in September. Go online, get registered for that early so they can get a count for everyone. And if you're not sure about it, just give Kelly a call or Emily, and they can help you out there at the center. So we're going to go ahead and get into the life cycle cost analysis. I'm going to turn this over to Dr. Newcomb, and we're going to rock and roll here. Dave, thank you again for being here.
Well, thank you, Larry. Good morning, everyone. And it's good to be here. Good to be inside and the air conditioning out of the 100
It certainly is, yes.
With the wild swings in the stock market here over the last couple of days, I'm happy to tell you that we're not going to be discussing what happens from one day to the next. What the point of life cycle cost analysis is to take the long view in economics and to make decisions that will hopefully pay off over the long run. Now, in order to do this, there are certain things that we need to point out. There's some uncertainty with some of the assumptions that we make, and that's always going to be true. And we have to rely heavily on what has happened in the past over the long term in order to project forward, simply because, as we'll discuss later, you can't tell the future. Nobody has that ability. And actually, if any of us were able to forecast what the economy was going to be doing, we probably wouldn't be sitting around our telephones right now.
Exactly.
So what is life cycle cost analysis? Well, and this is a concept that's oftentimes taught in engineering programs, and people go in and they hear about ways to compare projects from an economic standpoint, and oftentimes this is done by looking at what the equivalent annual cost of certain options are, or what the present worth of options are, in order to find out which one is the most economical. What you're going to find, or what we're going to talk about today, though, is the fact that life cycle cost analysis is just a tool, and it is there to help make decisions. It is not a decision in and of itself. So it's important that we keep that perspective in mind when we're going forward. There are times when the economic decision may not be the main reason that we choose one option over another. There may be other considerations, and so again, this is just a tool in the toolbox. So, as defined by T21, which was a legislation passed in 1998 for transportation funding, life cycle cost is a process for evaluating the total economical worth of a usable project segment by analyzing costs and discounted future costs. And by future costs, what we're talking about are things like maintenance, rehabilitation, reconstruction, and resurfacing, but all of these things that might occur over the lifetime of the pavement. Well, how's it used? Well, one way is to make go, no-go decisions. If you don't have the funding to complete a project, and you're not anticipating having the funding going forward to maintain it, it may be best just to not invest the money at this point in time. Also, to evaluate the economic impacts of engineering decisions. And so, in this sense, again, it's a tool that's separate from what we do for design. We use design to come up with the best approach for constructing a particular pavement, but in the end, what happens over the long term in terms of money that we have to invest in maintenance, rehabilitation, and reconstruction. The picture here is the Bridge to Nowhere. It's a famous bridge in California. It was constructed actually back in, I believe, 1936. It's in the San Gabriel Mountains, and it was intended to connect a couple of different, a couple of different small towns up in San Gabriel. But it was never completed because the road was never completed. And so the bridge is standing today, and the only thing that it's really used for is bungee jumping. So if you want to think about extremes in terms of engineering considerations, it might have been cheaper just to go out there and build a wooden platform and have people bungee jump off that rather than go out and build a concrete bridge. But again, that's...
and the thing about it, you got to decide too about this funding. Like you were talking about, if we're not going to have enough money to do the project, and I'll say it like this correctly, then our maintenance costs are going to be escalated. The road's not going to function right. The traveling public will be blaming it on the asphalt roadway or the asphalt itself, and that's really not the culprit, so to speak. So I love that go and no-go decision. I think that's fantastic.
Right, and so in the past, especially back in the 1980s, a lot of engineering decisions were based upon the availability of money. And Larry and I were talking earlier about what I would call policy overlays. Mm-hmm. And that is where essentially the agency would be told how much funding it was allocated, and then they would take the number of miles and then divide that into the number of dollars they had. So you had the number of dollars per mile that you could allocate, and from that you came up with the thickness of your overlay.
Wow.
Well, that is it's wasteful in kind of a big sense, because you may have been repairing roads that didn't need it at the best time, and for others it may have been an inadequate design for what was needed. So in that way you actually wind up losing money on both ends of the spectrum.
Wow.
And so again, how is it used? It's used to make to select the most economical choice among alternatives. And so it's not always clear cut as to what is the most economical choice. Again, you have to look at it over a period of time and make sure that the structure that you're looking at has a use or a life that will encompass both rehabilitation and then at the end of that, what the reconstruction costs are going to be. It's also used to drive competition in initial bids, and this is something that's done quite a bit. It's called A+B bidding, and basically here what the A and B are alternatives. Alternative A in this case has a lower initial cost, higher future rehabilitation cost. Alternate B has the higher initial cost and lower future rehabilitation cost. And so you take the alternative with the lower initial cost and you add to that the difference between the rehabilitation cost and future in order to come up with a comparison in terms of bids that may be submitted for different types of structures. And it doesn't have to be always just concrete and asphalt. It can be a number of things. You may have different designs that you're comparing. For instance, you may have a stabilized base course in one instance versus an unstabilized base course with a thicker asphalt section on it. There are a lot of different variations of design that can be evaluated.
But in this case, I guess I can say it like this. In A or B, you get what you pay for.
Exactly, yeah.
But I love that part about lower future rehab costs. Pay for it up front, let's get a good job, and it'll last a long time.
Mm-hmm. Yeah, that's, and there are other considerations, and we're going to talk about this in a minute when it comes to economics. And one of the biggest considerations that is frequently left out are the user costs. And user costs can be very significant, particularly in metropolitan areas where you have high traffic volumes and you have issues with relatively high construction costs because you're trying to construct it under traffic. Oftentimes you're trying to accelerate the construction. And so there are a lot of different things you can use in terms of an economic analysis to make decisions. User costs, by the way, are very difficult to pin down for any particular project,
right,
simply because you don't know who's going to be driving through the work zone at what time. But you can make assumptions about the traffic mix and the cost for certain types of vehicles and occupants. And the FHWA actually made a study of this back in the late 90s, and I don't know if it's been updated, but it basically had a different cost for instance, cargo trucks versus passenger cars versus buses and that sort of thing. So the FHWA recommended approach, and the one that's used most often for comparing alternatives, is the net present value. And so in this, what you're doing is you're taking the total of the initial cost and the discounted future cost, and you bring all of those back to the present for comparison. And so your future cost, you apply what's known as a discount rate, which in this case is defined as being the quote-unquote real discount rate, which is basically the difference between interest that you might receive on bonds versus the rate of inflation, and accounts for the time value of money. Now, what you do in a situation that I heard about yesterday where banks are actually charging negative interest rates, I have no idea.
No.
But, that's not the norm.
No.
And that's not something that's going to last over the long term. So we need to look back, and we need to look at what interest rates have done over the past 30 years or so, and inflation has done over the last 30 years in order to get a number that's reasonable. User costs, as I was saying earlier, can be very high in particular situations, especially in metropolitan areas. And so oftentimes when you do the calculation for traffic delays through the work zone, you can actually come up with a figure that is larger than the construction cost itself.
Hmm.
And so from that standpoint, you don't want to completely lose sight of construction costs, but you do want to account for the inconvenience to motorists. And so I recommend that people use user costs more as an index of inconvenience more than anything else, and consider it maybe separately rather than trying to lump it in with the construction cost. So again, the Lifecycle Cost Analysis Policy Statement, the FHWA is a philosophy. It is a decision support tool. And again, like I was saying earlier, the results of a lifecycle cost analysis is not a decision in and of itself. And so you use the process basically for evaluating the cost of the pavement over its entire life cycle. And one of the things that you should do is to use it to improve maintenance and rehabilitation strategies. Again, when we talk about overlays, we want to make sure we're making a rational decision and making sure that we're treating the areas that need to be treated when they need to be treated. And that applies for both rehabilitation and maintenance. You need a logical evaluation process, and so if you are going to pursue this type of an analysis, you need to have the rules written down ahead of time. The agency and the user costs should be included. As I said, I recommend that the user costs maybe be considered separately, and again, have some weight in the decision. The future costs should be discounted to their net present value. And again, that is just taking the total of all the costs that you expect to happen over the 45-year period that you're going to do the analysis, have all of those brought back to the present to make comparisons. So it is an important consideration in all investment decisions. The level of detail should relate to the level of investment. All that means is that the more high profile the project, the more costly the project, the greater level of detail that you want to put into your evaluation. You want long analysis periods, and this is something that is very critical. For pavements, they recommend a minimum of 35 years. For bridges, they recommend a minimum of 75 years. And the reason for having long analysis periods is to make sure that you capture not only the rehabilitation and maintenance costs, but also to try to catch the reconstruction costs and make sure that everything is considered in the same way. And so if you have one alternative that is going to have a rehabilitation every, say, 15 years, then year 15, year 30, then at year 45, you'd have 3 rehabilitations in there, and that keeps the roadway going at pretty much the same level. Whereas if the other alternative has, for instance, a rehabilitation that occurs at 25 years and at, say, 35, and then is reconstructed at 45, you want to make sure that you capture all of that in there as well. Okay, so one of the things about life cycle cost analysis is it is not set in stone, and there is uncertainty involved in everything that we do when we try to forecast economic conditions, and so uncertainty is unavoidable. And the longer the projections, the greater the uncertainty. Traffic counts, technology changes, performance, land use, maintenance and rehabilitation intervals. You have to understand that all the things that are listed there are changing as time goes along. And for instance, somebody comes up with a super maintenance treatment where you treat it once and it's good for another 20, 30 years. That would throw the life cycle cost in a sort of a different direction. It would make things cheaper, presumably if the cost was the same. But the fact is that we know what we know, and what we don't know is there are things that we should not be assuming.
I was on a particular job here about a year ago, and it was a truck stop, parking lot, big entrance areas, and they had projected about 400 to 500 trucks a week. They were getting 800 a day, and they were having some slight pavement issues, and they had no drainage around the area that was installed. So they had built this with some unforeseen things, and now it was kind of coming back to bite them. But all their best judgment and analysis was, this many trucks, and then all of a sudden it was a very popular stop, happened to be in the right place, and they're having some pavement issues now, concrete and asphalt. So they're going to go back and look at that, and they're going to have already some rehabilitation they're going to have to do to this area. So.
Right. So yeah, the future has a way of biting us all.
Biting us, yeah.
My last bullet point down there is a holdover from my thermodynamics class at Texas A&M. That entropy, I still don't know what it means,
Right.
but I know that things are changing, and I can't stop them from changing.
Yeah, that's right.
So you know, we have these things that are out there that we don't know exactly what they're going to be, but we know if we have good data from the past in terms of maintenance and rehabilitation strategies, their effectiveness and their cost, then we can fold those into our consideration. And one of the big issues is that if you have a low quality of cost data, for instance, in maintenance, and you try to apply that in life cycle cost analysis, then perhaps you're fooling yourself. Oftentimes when things are done, for instance, with in-house forces in terms of maintenance, then oftentimes the records aren't quite what they should be. And so getting to the exact cost of what that treatment was is difficult. And then further beyond that is understanding how much improvement you got with the maintenance procedure. So kind of put this in a visual form, life cycle cost components are this. First off, we have the initial construction, and that is by far the biggest impact that we have on LCCA normally. Then we have maintenance that occurs at certain intervals, and depending upon the maintenance treatment, you either get a longer or shorter period before the next maintenance cycle. But again, for instance, we know that seal coats in Texas generally last probably somewhere on the order of 7 to 8 years. Mm-hmm. You know, so if you're planning on sort of a regular seal coating program, then you know, that's the sort of thing that you put in. However, if you don't seal at 7 or 8 years, if your intervals are more like 10 years or 12 or 15, then you need to be realistic about what you're doing once again, and put those in at the intervals that you're actually using.
So this maintenance line here could just be minor stuff like pothole repairs or anything. Now the rehab could be where we actually come in and repair and maybe do 1.5 to 2 inch overlay.
Yeah.
Periodically. Okay.
Yeah.
Or seal coat. Yeah.
Yeah. So you can come in and do, for instance, a shallow mill and fill. There are a lot of different options for rehabilitation. But basically what you're doing there is you're have a larger expenditure than you would with a maintenance dollar, but you would do it less frequently. And so you would have that occurring at intervals that would correspond to what your typical rehabilitation program is.
I see.
And finally, there is what's called salvage value, which is essentially the worth of the project at the end of the analysis period. So the salvage value is the fact that after your last rehabilitation and maintenance activities, you may have something on the other side of it, but you're not going to consider that. And so there is some time left before you're going to hit those, and that is considered in the salvage value of the project. So all of these things, the arrows going up, they're all costs. The arrow going down in salvage value, that is a value. It is an added value. And so we have this formula here, which is for net present value. I won't go into the whole detail, but it depends upon the initial cost and the sum of the the rehabilitation and maintenance cost, and then you have the discount rate that you're going to apply, and you have the year in which that activity is going to be applied. All of that then goes back into one single value at the beginning of the project called the net present value. So let's talk in practical terms about some of these issues. The initial cost is normally the most expensive component of the life cycle cost, and so it usually accounts for about 70% or so of the total life cycle cost. And sometimes it can be high as 80%, sometimes it can be as low as 65%, but it is by far the biggest influence on the life cycle cost. Material, unit prices and quantities, these things are considered into the initial cost along with the labor. Oftentimes they can be considered as part of the material unit prices if you're paying for the material to be delivered and placed. Traffic control, you need to have some concept of the daily and hourly cost for that. And one of the important things that needs to be pointed out here is that when you're comparing pavement types, you only consider you should not consider rather the mutually exclusive, or only consider the mutually exclusive costs. You don't want common costs like landscaping, lighting, all those other things to be included in it. And I've seen sometimes, particularly on airport projects, where not only are the pavement types included in the life cycle cost analysis, but everything from the drainage all the way through to the runway lighting was thrown into the equation. If you do that, you just mask everything.
Right.
And it really doesn't give you a true picture of the benefit of choosing one pavement structure over another.
So as traffic control would be a part of a pavement process, landscaping is not.
Right.
Drainage might be a part of a pavement cost, but lighting is not. So those are good considerations that I have not thought of before, that I really like about this, is understanding what the true cost is.
Right, and the drainage would only count if it's different between the alternatives.
I got you.
So if you have the same side slope and the same structures to drain the water, then it's not really part of the analysis.
Got you.
Now, this is another thing that happens sometimes in life cycle cost analyses that is actually pretty disconcerting, and that is you should not use a strategy that cannot actually occur. And so some good examples of this. An alternative that has very little or no rehabilitation for 45 years, that's not really a practical assumption at all. And I think we all know that some sort of maintenance and rehabilitation is going to occur, and those costs need to be factored in. The other one is, for instance, unrealistically close rehabilitation intervals. If you assume you're going to go out and put an overlay on every 8 years, you might want to think about a couple of things. Number one is changing your specifications or your methods. The other is that if you're doing this every 8 years, consider at the end of 40 years how thick your pavement's going to be if you're going to go out and overlay it every 8 years. Often, and I've seen sometimes, for instance, unrealistically thick pavements at the end of the analysis period. There's one case for one state that I won't name where they had a pavement at the end of 35 years that was 18 inches thick.
Wow.
For a highway. I mean, that you're talking major airports there when you
You're
start
right.
talking those kind of thicknesses.
That's amazing.
Also, unrealistically frequent maintenance. There was one time when I was looking at, again, an airport comparison of alternatives. And for asphalt, they had the maintenance intervals every 3 years for going out and crack sealing. And then on top of that, every 5 years, they went out and with a micro seal,
Wow.
microsurfacing at every 5 years. So when you start thinking about how much stuff you're dumping on top of the pavement, it doesn't make any sense. Not only that, but the fact that the microsurfacing may not have been a real appropriate maintenance strategy once you've crack sealed. But I digress. And then on top of that, they also had an overlay occurring at every 10 years. And so they had all this stuff dumped on top of each other. Well, again, you need to be realistic about what your expectations are for maintenance and rehabilitation, and also whether or not it would actually occur. I mean, there's usually enough information on a roadway system that you can make these kinds of judgments without following an exact schedule that would tend to lump a lot of maintenance and rehabilitation where it's not actually going to occur. So there's uncertainty in performance as well. We have our if we have our pavement management program set up, we know what we're going to do in terms of restoring the ride quality at different intervals, and in this case, that blue line might show what you might expect out of an average project if you got a super duper mix and an excellent contractor, which many of them are, and you got great weather conditions or lower loads than you expected, then your performance is going to behave differently. And so there is some uncertainty into how the pavement performance is going to how it's going to occur, or how it's going to perform over time. And so in doing this, it's good if you can kind of understand what sort of natural variation you have in pavement performance, just in order to give yourself a little bit of spread in terms of how you go about calculating the life cycle cost. Discount rate. It took me forever to kind of understand what this is, but it is essentially a way of accounting for the time value of money, and it's the time value of money that we consider. It is not the history of commodities cost. So we use the net present value equation to bring future costs back to the present. Again, FHWA recommends what they call using a real discount rate, and this is something that is set by the Office of Management and Budget. It does not include inflation factors for prices because those future cost the future cost estimates for instance, construction prices should not include inflation because it's all wrapped up in this number called a discount rate.
I see.
So it does include the general inflation in, again, the discount rate. And FHWA in the past has recommended a value of about 4%. Most DOTs, I think, probably are somewhere on the order of 3% to maybe 5%. Usually it's recommended that the discount rate that's applied be done over a 30-year history. And so you'd go back and you'd look at the difference between the inflation and the interest rate for those 30 years, and then use the average. And so this is a graph kind of showing what it looks like. The upper line there is the yield on a 10-year Treasury note, and then the bottom line is the actual yield to investors after inflation. Again, the difference between those two gives you the amount that's lost to inflation. So again, the discount rate is something that varies over time. You can see that some years it's less, some years it's more. But if we look at it over a long period of time, then at least we've got a realistic number for what's happened in the past. And so what is the effect of the discount rate? Well, you can tell that by looking at the present value factors for different discount rates. And you'll see that in this table, discount rates are there on top, going from 4 to 6%. And then the year, as the years go by, from year 0 to 5, it's listed over there on the left. If you look at the 4% column, you'll notice that it starts at 1, just like they all do for year 0. That would essentially be the initial cost. But as you go along, you'll notice that for 4% discount rate, the discount, or for a 4% discount rate, the present value factor decreases less than it would at 6%. You'll notice that after 5 years for the 4%, the present value factor is about 0.82, and if you go over to the 6% column, it's about 0.75. So it does make a difference in terms of what you assume for a discount rate. That's why it's always good to go back over a longer period of time and look at what the discount rate is for a period of about 30 years, and make sure that you're not capturing things that are only occurring locally. And then the net present value is the future cost times the net present value factor. So whatever your maintenance cost is at year 15, you would then multiply that in terms of the cost, the present day cost times the present value factor, and that would give you the net present value for the rehabilitation or for the maintenance. This is another way of portraying the difference in the discount rates, and you can see that for a 6% discount rate, you've got a much lower percentage of the original value than you would with a 4% discount rate over 40 years. Now, oftentimes there's an argument made that things should be, an economic analysis should be done with material-specific discount rates. First off, there is no definition for a material-specific discount rate. It's not an accepted practice, and as of now, it has not been adopted by any state agency that I'm aware of. And from the Office of Management and Budget, which basically sets the discount rate, it says, regardless of any assumption about relative prices and cost, all alternatives being compared should be discounted with the same discount rate, following the guidelines in Section 9 of Circular A94. And Circular A94 is the document from the Office of Management and Budget, and you can get it online. All you have to do is do a search on Office Management Budget Circular A-94, and it will take you right to that publication. Basically, by having a material-specific discount rate, it would be the same thing as trying to speculate in commodities. Again, that's not a particularly good practice. And so we talk about things that happen in short terms. And although this was from, I think, 2008, it seems that maybe we're close to it again, that, there's a market crisis, Wall Street's imploding, the interest rates are upside down, et cetera, et cetera. The fact is, we don't know when these things will occur. We know that they will, and they may and probably will occur. But as the famous chemist Niels Bohr once stated, prediction is very difficult, especially of the future.
Right.
And so, again, we should hedge our bets and make sure that we're looking at the long term. User costs, again, they account for delays due to construction activities, work zone slowdowns, the time spent in queues. Sometimes they account for crashes and wear and tear due to braking and acceleration. So they encompass a lot of things in terms of vehicles and the cost of doing business. And so user costs are important to try to account for things, but sometimes when we do the analysis, it can leave you with some unrealistic conditions like an infinite traffic queue, which again, if that happens, people normally find a way around them. So you have to be careful about how you apply user cost, but it is something that is very real to the people that are sitting there in traffic. So in summary, the life cycle cost analysis needs to be a part of the overall pavement type selection process. It is not the decision itself. I mean, we all need to remember that. Rehabilitation intervals are very important, and real performance data, not guesses, are the things that should be used. The discount rate needs to be realistic, and it needs to be applied uniformly across different alternatives. The user costs are important, but should not be added directly to the agency cost, but they do need to be considered at least as an inconvenience factor. So with that, pretty well wraps up what I've got for this morning.
Fantastic. I don't see any questions up on our board right now, but if you got any questions about this particular webinar, just call into the TexAPA office and just give them your question, and Kelly or Emily will contact me and we'll get you an answer to your question if we can help you in any way like that. Dr. Dave Newcomb, we thank you for helping me out today.
Well,
kind of a short notice. Is a great presentation for anybody that's anticipating doing any cost analysis of a project. They can follow these guidelines. So we want to thank everybody this morning for dialing in. We had quite a number of call-ins today, 68. That's a great number. We don't know how many people are listening on each one of those phone calls. So again, we thank you for tuning in with us. Remember, we do record these. You can go back and re-listen to anything we have. And thank you much, and we'll sign off.
Thank you all. You have a great day.
All right.